to Macro Insight. Today is the 23rd of February, and let's take a look at markets. So, okay, what's been going on? So we've been talking about this sort of yields going higher story last week. Finally, as yields continue to break higher over the weekend, you know, the equity market did kind of get a bit spooked. We had also said that, you know, it may be that equities is being held up by a bunch of gamma that's pinning the S&P around 3,900, and that's struggling to let it move. And once that gamma expires on Friday, then will the market be a bit freer to move, and will the actual move that it wants to have actually happen? And that's kind of what we've seen, and that's been led by the tech sector, which again, no surprise, because the tech sectors should be the ones that, you know, get hit in a higher yield world, basically, right? Everyone kind of happy with why that's the case, why tech stocks will generally sell off when rates go higher. When, you know, the way these companies, they don't have any earnings today. A lot of them have no earnings but are expected to grow and kind of capture market share and become profit generating companies in 10, 20 years time, maybe. Okay. And when rates are so low, or when real rates are negative, then you actually get a high valuation based on those future cash flows. But when rates go up, then the present value of those future cash flows is much lower, and therefore your current stock price valuation goes down, basically, when there is actually a cost of capital. When there's no cost of capital because rates are zero or negative, then tech stocks are worth a lot if you think that stock's going to be around and that company's doing stuff that, you know, is going to mean that company is a company of the future, basically. Yeah. Anyway, so that was the main reason and driver for this sort of wobble in equities. You know, what we've also seen a lot of with kind of yields going up is this rotation trade continuing. So you have the likes of energy companies linked to the oil price going higher. You've got financials going higher because of the steeper yield curve. And you've also just generally got a bit of some of these companies that have been out of favor, that are going to make money on a reopening of the economy and stuff like that. They're outperforming, right? So you've definitely seen more rotation towards the value stocks, and you've seen energy outperforming, right? So that's kind of what we've seen so far. The UK has announced their plan to ease lockdowns, which is great. Sort of a roadmap. They've done about 26% of the population, I believe. And they've done a hell of a lot of, in terms of the vulnerable people. So, you know, they've laid out their roadmap. Everyone's quite happy with how the UK vaccine rollout's been working. Compared to Europe, they're knocking it out of the park. I mean, Europe's done about 6% of their population versus UK done 26. So it's quite a major divergence there. I think in Europe, there's quite a lot of resistance against the vaccines and about their effectiveness and things like that. So that's kind of slowing it down a bit. But in terms of the reopening, I mean, you have to expect the UK, you know, the UK reckons they're going to be fully reopened by June. That's the plan. We'll see if it plays out that way. But I think Europe's looking at a much slower reopening if that's the rate of vaccinations by the looks of it. The US seems to be doing okay as well, progressing nicely. There were also some good studies out from Scotland saying that there's like a 94% reduction in hospitalizations after one dose of the vaccine. So, you know, generally very, very positive vaccine news, fueling optimism about the recovery and pretty much fueling this rate move, right? This rates move, this bond sell-off is because people are expecting the recovery to happen, and it's natural to move out of bonds and into riskier assets if that's what you think is happening, and also if you think inflation's coming, basically. Yeah. What else have we had? We've had the extreme cold weather in the US has calmed down a bit. So US oil production went offline. I think about 40-50% went offline, but now that's only 15% offline. So you would have expected, you know, the snap higher in oil prices to kind of fade a bit, but that hasn't really been the case. That's actually continuing to charge higher, just on the back of, you know, Goldman's and Morgan Stanley upgraded their oil price targets to like $70, $75. And basically, that seems to be, and the demand recovery side, and the fact that the market's quite tight now because of all that reduction in US supply, that seems to be the bigger driver in oil right now, and it continues to go higher. Yeah. And then, yeah, so an interesting chart, obviously, on the whole rates dynamic. You know, the reason why the market's getting spooked, I mean, yields have sort of been going higher for a while now, and equities have managed to be okay, but it's more rate volatility, right? So like I mentioned this last week, here's a move index, right? So this index basically is the volatility. It's like the VIX for interest rates, right? So it's a Merrill Lynch move index. It gives you a measure of interest rate volatility. And it's that spike in interest rate volatility from around 40 earlier in the year to 60. That's what's got the market nervous, right? So you know, if you look historically, generally when yields go higher, markets go higher too, right? It's a risk-on thing for yields to go higher, but it's when the volatility gets a bit out of check, yeah, that's when things get nervous and things start to wobble. And people were wondering whether this spike in move is going to lead to a spike in VIX, and that spike in VIX basically means a sell-off in the market. Those two things kind of come hand in hand, pretty much, right? So that's really the thing that's kind of got the market concerned. Yeah. And then the other thing of note that happened yesterday was Brazilian president sort of got rid of the head of Petrobras. Okay. So that stock was, that's like, you know, big oil company in Brazil. That stock was down 20%. It's a large part of the index. I think it might be 5% of the Brazil index. But basically that got the market spooked a bit in EM. Maybe some foreign capital moving out of there, thinking that his policies might now pivot away from being so market friendly. Bit of weakness coming out of Brazil there. Like we've been talking about EM generally doing quite well in a weaker dollar environment, but it very much does seem, in terms of EM, you want to be concentrated more towards Asia than you do in LATAM, because you've got some of these political risks and stuff, particularly in Brazil. Okay, so that's kind of what's been happening. In terms of news coming up this week, or what we've had this week, we had the German IFO, business confidence came out better than expected, above expectations. I mean, that didn't really do much for the European equity market. If anything, it just kind of confirmed the bonds move even in Europe. So yields in Europe are rising as well. But the bund yield is, the 10-year bund in Europe is still at minus 0.3% yield, right? So, I mean, it's a bit of a different story to what's going on in the US. You've also got US consumer confidence coming out this week. Interesting, just because you want to get a feel for what confidence is, like I mentioned last week, because that's going to give us a read on how much of the fiscal support that hits people's bank balances, how much of that's going to then get converted to spending. The confidence of people is going to give you a feel for that, basically. Okay, you've got Fed Powell doing his semi-annual testimony to the Senate. That's going to be important. People are going to be watching that. That's tonight, I believe, at 3. But what's going to happen there? People will just be looking to see what he's got to say about yield. Right? Everyone's spooked about potential inflation and this yield move, this backup in yield. So they're going to be looking for him to reassure markets, basically, right? Anything he says is going to probably be directed towards trying to control volatility, right? All central banks want to do is suppress volatility, right? So whether it's equity volatility, whether it's bond volatility, I think they want to suppress that volatility. So he's going to try his best to kind of talk that down a little bit, I suspect. Okay. Some people have thought, you know, are they going to talk about when they're going to start tightening and trigger a taper tantrum, all that kind of nonsense? Can't see it happening personally, right? I think that would be really quite stupid for them to do. I think they've got slightly more awareness about markets and how markets are going to react and how markets are hanging on to every single word they say. So I don't think that's what they're going to do. Okay. So those are kind of the main things that have been sort of driving macro and what's going on. Now let's have a little look at the charts. Right. So if we have a look at the S&P. So I'd put this chart out on Twitter the other day. And basically, you know, I did my usual Fibonacci confluence to get my support levels. And I'd said, you know, we already hit the first support at 38.70, but I had kind of favored we were probably going to go a bit lower. So now we found the second level at around 38.50, and we're we're in decision mode, right? Are we going to hold this level? Okay. So for now, we kind of are holding on to 38.50 around here. Next level below that I've got is 38.15. But this seems to be, you know, showing signs that it might want to hold. Like I say, what I generally like to see is some bullish divergence when we're hitting these major sort of support levels. And, you know, if you look here, this momentum indicator hit a low there first time we tested. We kind of bounced. Now we're kind of retesting and it's not gone down as much. That's only a 1 hour chart. If I get to see those type of divergences on multiple time frames, that's when I get excited. Yeah, that we might be hitting a local low. So again, you're looking at a 2 hour chart. You know, we made those lows yesterday on some weak momentum. We're now making lower levels today on less weak momentum on the 2 hour chart, and similarly 4 hour chart signaling same sort of story, right? If you look here, actually no, that's tell a lie. That's probably versus the low we made maybe last week at 38.85 ish. Versus that low on the 4 hour chart, we're getting some divergence actually. So yeah, that's not so bad. So on 3 time frames, we're getting some divergence. We're hitting some levels, and you know, for me, the whole dynamic that's driving this rally isn't really changing. It's just, you know, the market needed a bit of a washout in tech, and we got that. And we'll have a look at the Nasdaq chart in a minute. But again, you look at the Bollinger Bands. We went from kind of the top end of that range, top end Bollinger, back towards the middle. I mean, could we have a push down towards 37.40 to the bottom end of the Bollinger? It's possible. I just suspect that the market's probably going to be too strong to manage it, right? And we'll see if the Fed doesn't say anything stupid tonight, then I suspect the market's going to hold and probably recover, right? But that's just my kind of feeling on what I think. And part of that feeling is just because the correction we had earlier in February, the speed at which that recovery came, the speed at which that market roared back, it was just telling me that there's just a very, very strong underlying bid to this market. And that's why I don't think corrections are going to last for very long, especially if the fundamental economic backdrop is looking favorable, right? Like I say, yields, yes. Look, if yields go up too fast, then the tech sector will not like it. But there are some seriously strong parts of the economy. There are some serious strong parts of the market on the back of those higher yields, like energy, like financials, that are going to keep roaring higher. And I think that's something that's probably going to take this market back up again. Like I say, if this 1.1 trillion is hitting the market in terms of cash liquidity, that's probably going to find its way into risk assets in some shape or form. And that's what I suspect is going to fuel the rally as well. Okay. So I think what happens, you'll get these short-term wobbles in tech when rates go up too fast. Once the market digests the yield move, and yields kind of go and stay in like a 10-20 bip range for a little while, and the market just recalibrates itself to the higher yields, then they'll look at these tech companies, decide whether or not their earnings are still growing, decide if they still want them. There might be some differentiation within the tech space. So there might be some companies like Nikola, which is no fucking hope of ever making any money. Maybe that doesn't get bought as aggressively, but the likes of the mega caps are going nowhere, right? So there might be some differentiation within the tech space, but the tech space as a whole, I don't think falls out of bed, basically.
Okay.
Yeah, I mean, look, you are at risk. Like, you know, people have been warning that tech is in a bit of a bubble and it's overvalued and blah blah blah, and the kind of the straw that breaks the camel's back is yields going aggressively higher. Okay, so you are by having that position on, you are risking that the Fed doesn't manage to calm the market down and yields just kind of snowball. And I think yields should find some resistance at 150. But if yields smash through 150 and go to like 2 quickly, then tech's going to be in for a shit show. Okay. So you just need to know what the risks are and manage them accordingly, right? I don't think that's the base case. I don't think that's what's going to happen.
Yes.
But if yields smash through 150, expect tech to be down at least 10% more quickly, right? Because the market will shit itself. Yeah. All right. So commodities, oil, start with oil. So generally, yeah, I mean, I thought oil would have a pullback. I thought that sort of breakout up towards 62 was on the back of the cold snap in the US. And once that thawed out a bit and production came back online, you know, I wasn't predicting some massive collapse, but I thought a pull back to like 58 maybe was quite realistic. So we'll see if it plays out that way. But it seems that the whole world's kind of fixated on the idea that supply in oil's got a bit too tight now versus what demand's likely to be given the reopening. And that's a bigger driver right now. So that seems to be what's going on. Like I said, Goldman, Stanley's, they've upped their price targets for this next 6 months to about 70, 75. We'll see if we can get there. I mean, a more interesting one for me is copper. So I had been calling for this copper thing to move to 4. I mean, it went a bit quicker than anticipated. I didn't manage to actually get any copper on. I bought a copper miner, Freeport McMoran, which has killed it. But annoyingly, I didn't get any of this stuff on, which I wanted to. But I was being a bit greedy. I was looking for this sort of consolidation here to have a bit of a downside exit towards 340, and I was going to pick it up there. But I missed that, and now we're already back above 4. So that's quite frustrating. Trend is super intact in copper. This is quite an interesting chart. So this is the copper gold ratio, been absolutely going parabolic, right? And this is, if you look back, sort of going back to 2018, this ratio was in lockstep with yields, basically, with the 10-year yield. And so you've seen this massive explosion in copper, right? So the copper gold ratio is basically signaling to you inflation is coming and the yields are following it, basically, right? So that's kind of what's going on here. I do think it's got a bit parabolic, so maybe copper does have a pullback and I get a chance to buy it again. This stock that I bought, that is the copper miner that I bought, I think is up like 40, 50%, which is ridiculous, right? But I'm not planning on selling that because for me, that's just a long-term hold, right? Because that thing, I think, has got a lot of legs in it still, yeah? Okay, so that's copper. Gold, obviously, is a big one. Oh, that's nice. Gold's come off. Okay, so I've been banging on about shorting gold for the last day or so. Didn't make any sense to me why gold was up so much yesterday. Real yields were higher. Yeah, everyone's spooked about yields, real yields, inflation, all that stuff, and gold rallying. I didn't think that made a lot of sense. If the biggest driver of gold is real yields right now, gold should be getting hammered, right? So I suspect gold does take out that downside support. Actually, I haven't shared that. Let me share that chart. Okay, so this is the gold chart. I had said that support was under attack at 1760. It literally touched 1760 last week and then bounced hard off that. So it seems to be some decent buying interest down there. Now, if that level gets taken out, which I suspect it will, if real yields continue to go higher, which again, I suspect they will, then I think the next level is 1670. I am playing that from the short side now. I've been using this bounce to get short some more. I started buying puts on the way down last week as we were starting to look like we wanted to break that level. Obviously, those puts didn't do amazingly because we bounced, but that's why I did puts and not straight delta. But now in this bounce here, that if you look, that bounce on the dailies, that's gone back towards the average on the Bollinger. So for me, that's quite a nice entry. I also, where was it? I was looking at some levels. This chart here. So I was looking at some confidence levels of where this bounce might fade out. And we had a level here at about 1813. And it looks like it's failed there and it's heading back down. So I'm favoring over the next few weeks a break to the downside in gold. The big level is 1760. If it breaks 1760, it goes quickly to 1700 and maybe 1670. That's what I think. So I like being short it. I've got a relatively tight stop on my delta short. I'm using like a 1830 stop on my delta short because that's just a little top up. But I've been buying options, been buying the end of March 1750 puts and the 1700 puts. And yeah, let's see how that plays out. And I've also reduced my long-term exposure to gold. So I've taken my long-term pension allocation in gold down from highs of like some ridiculous number, like 50%, to probably about 15% now. Yeah, which is about as low as I've been ever. right? So that's shows my kind of conviction on what I think on gold. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.